Hey, my name's Daniel. My wife and our family has 18,000 in Yotta.
Over $60,000 frozen up in Yotta.
7,270 and 60 cents.
$98,000.
94,000.
46,000.
15,440
Frozen up in Yotta.
frozen in Yotta.
Millions of dollars and thousands of people nationwide who haven't been able to access savings accounts.
Yotta Bank's sudden fall destroyed millions in savings overnight, a dark sign of how fintech dreams can turn into heartbreak. This isn't just a bank closing, it's a burning warning flare for anyone who thinks that easy-to-download bank app is a safe fix. The promises of quick wins and safe growth were built on shaky ground, and now families are left shocked and scared. People who trusted Yotta watched their hopes vanish in hours with no way to pull their money back. Tune in, because that simple app on your phone could soon bring you the same devastating nightmare, and you won't see it coming, when play money becomes real pain. Every $25 you saved, or whatever the set amount was, gave you a ticket to join in a weekly number draw. You could win small prizes, big prizes, or even have a small chance at a huge jackpot worth millions. It felt exciting and active. You weren't just saving your money, you were playing a game using your own savings as your chips in a game where you weren't supposed to lose because the money you put in was meant to be safe. Yotta made saving feel fun and even a bit addictive for a generation that grew up using apps and getting instant rewards. And behind all of it, the most important promise was written clearly: FDIC insured. Those three words were like magic, making people believe that no matter what happened, their money was protected, and they could go to sleep at night without worrying. But that peaceful feeling turned into a terrible shock. For me, seeing tens of thousands of dollars vanish from my Yotta account wasn't just some numbers changing on a screen. It felt like a punch to the gut. That was the down payment I had saved up carefully for a home, or the emergency fund that was meant to help my family if something went wrong. Imagine logging in one day, maybe after reading some scary posts online, and seeing your account show zero, or maybe even worse, seeing the right amount sitting there but realizing you couldn't touch it because the account was frozen and nothing worked anymore. You try to reach customer support, but all you get are automatic emails, long waits on hold, or agents who just read from scripts and offer no real help. You go searching online, looking through Reddit or Discord, and you see thousands, maybe even tens of thousands, of people saying they're facing the same panic. People were missing rent payments, getting hit with late fees when automatic payments bounced, and seeing overdraft charges from their linked regular bank accounts because the transfers from Yotta never arrived. Even the most trusted YouTubers were promoting this mess.
This video is sponsored by Yotta Savings.
Yotta, Y-O-T-T-A.
Yotta Savings?
The Yotta Savings app, maybe you saw a couple people talk about this.
I decided to invest an undisclosed amount, and now I can officially say I am a small owner in Yotta Bank.
The same app that used to feel smooth and easy now felt like a digital prison, holding your money just out of reach and showing you the total amount of your financial fear. And that FDIC insured promise that once felt so comforting, it started to feel like someone was playing a cruel trick. Now let's get into the details, because this is where the real problems came from. Yotta, it turns out, wasn't the bank itself. It was just the part the customer saw, the pretty surface, the real behind-the-scenes work, the engine that made sure money flowed properly, checked customer identities, that's called KYC or Know Your Customer, followed anti-money laundering rules, processed transactions, and most importantly, kept track of who owned what. All of that was mostly handled by a company called Synapse Financial Technologies. Synapse was a big name in what's called banking as a service. It provided the tools and connections that let non-bank fintech companies work with real banks like Evolve Bank and Trust or Lineage Bank. You can think of Synapse as the complicated software and regulatory bridge that allowed over 100 different fintech companies, based on some industry estimates, to offer bank-like services without being a bank themselves. This setup made it much easier to launch fintech products quickly. But it also created a dangerous situation where many companies depended on one key player. When Synapse started having problems, people had been hearing rumors for months about money troubles and fights with its partner banks like Evolve. It wasn't just one company at risk, it was the whole system built on top of Synapse. And then the disaster hit. Synapse filed for Chapter 11 bankruptcy, sending the case to a major US bankruptcy court, maybe in Delaware, where big corporate bankruptcies are often handled. Filing for Chapter 11 means a company is asking the court for help reorganizing its business, or sometimes, if that fails, shutting down. But the immediate result was that everything froze. The company's operations stopped, and any access to money being held or moved through its system was cut off. Why did Synapse go bankrupt? Reports from the court and the news said the company ran out of money because of high costs, lost partnerships, and possibly poor management. Most importantly, the relationship between Synapse and Evolve Bank had broken down over arguments about account records and following rules. As a result, fintechs like Yotta couldn't process transactions or access customer money. Customers were locked out. Billions of dollars, some early reports said it might be hundreds of millions, possibly affecting over 100,000 people, were suddenly stuck in limbo. Now, we need to look again at that FDIC insured promise under the hard light of bankruptcy. The type of FDIC insurance used here, called pass-through insurance, is real, but it depends on important conditions. The middle company, Synapse, and the partner bank, Evolve, have to keep perfect, clear records that show exactly who owns which funds in the accounts. That way, if the partner bank itself fails, the FDIC can figure out who should get paid back, up to $250,000 per person, per bank, per type of account. But Synapse didn't just have a small stumble, it fell apart completely, with early reports from the bankruptcy court saying its records were a total mess. There were questions about whether the money had been mixed up between accounts or whether the records were even complete or correct. That makes the FDIC's job extremely hard because they can't protect or pay back money if they can't prove exactly who owns what. The FDIC has already made public statements about this situation, and more information is still coming out.
I've got clients calling me now who are sending me notices saying I was owed $84,000, I'm gonna get $30 back.
The people in charge said they want to protect the depositors as much as they can, but they made it very clear that they need good records from all the middle companies involved. Records that might not even exist or might be messy and hard to trust. This means that the FDIC, which is supposed to keep money safe, is no longer a simple guarantee. Instead, it has become a tricky and confusing process where people may need to hire experts to figure out where the money went, and the bankruptcy court has to approve everything. This also brings up big questions about brokered deposits, which are funds handled through middlemen. The rules for these deposits are complicated, and it's not clear if the $250,000 insurance limit applies to all the money at once through Synapse, or if it applies separately at each partner bank if the money was spread out properly. What people thought was clear has now turned into something very uncertain and confusing. The Synapse bankruptcy court has now become the center of attention, almost like a wild scramble with many groups trying to grab what they can. Synapse's own creditors are fighting for money. There are dozens of fintech companies like Yotta that are desperate to get back their funds and may even sue Synapse for breaking contracts. The partner banks like Evolve are trying to protect themselves from blame and are making their own claims. And then there are the depositors, everyday people like me, who may need to file claims in a legal process they barely understand. A court-appointed trustee has been given the huge task of gathering up any of Synapse's remaining assets, looking into what caused the collapse, sorting out the tangled records, and running the claims process. Meanwhile, big law firms are working for all the companies involved, charging huge fees that will probably come out of whatever money the trustee recovers. And this will happen before any of the depositors get paid. Class action lawsuits are almost certainly being planned or already filed, aiming at Synapse, Yotta, maybe Evolve, and possibly even some top leaders, accusing them of being careless or dishonest. While these lawsuits offer one path to getting money back, they take a long time, are very complicated, and usually end in settlements where people only get a small part of what they lost after paying legal costs. The legal process moves very slowly, but people's financial problems are happening right now. A year after Synapse's fall, the financial wreckage remained. Millions lost, trust shattered, and victims ensnared in a torturous aftermath of blame, belated oversight, and the dawning horror of justice denied. Let's take a step away from the legal talk and think about the human side, the real stories hidden in the court papers. Online communities made by affected users show a heartbreaking picture. We are hearing many stories, sometimes secondhand but very common, about people who can't get their Social Security or disability payments because they went through fintech companies tied to Synapse. Small business owners who use these services can't pay their workers or their bills. Families who saved money for important medical treatments are seeing those funds vanish. Students are dropping out of school because their tuition money is stuck. The stress is overwhelming. People are reporting feelings of anxiety, depression, and a constant need to check for updates, feeling powerless and betrayed. What was once the shiny promise of fintech making life easier has now become for them a deep financial disaster. This is not just a small problem. For many, it is a life-changing crisis, forcing them into debt, hardship, and emotional struggle. This failure has broken not just their finances, but their trust, with painful real-world effects. As expected, this disaster has sent shockwaves through the government agencies in Washington, D.C., the OCC, the Federal Reserve, the FDIC, and especially the Consumer Financial Protection Bureau are under heavy pressure and have probably already started official investigations. Big questions are being asked. Did the regulators watch over BaaS companies like Synapse closely enough? Did the partner banks like Evolve check and keep track of their fintech partners the way they were supposed to under the rules? Did Synapse and the fintechs using it, like Yotta, mislead people about FDIC insurance or the safety of their money? We can expect tough questions, demands for records, and possibly big punishments in the near future. Things like large fines, legal orders forcing companies to change how they work, or even actions against certain leaders. Regulators are probably working fast to update their rules or create new ones focused on the risks that come with the BaaS model, such as better record keeping and clearer explanations to customers. The collapse of Yotta and Synapse has become a painful example of how new ideas and complex systems can grow faster than the rules meant to keep people safe, leaving dangerous holes that customers can fall into. The effect on the fintech world will be deep and long-lasting. This is not just a public relations problem, it's a serious challenge to the trust and working methods that many fintech companies rely on, especially those that depend on BaaS middlemen. Investors are now much more cautious. Venture capital funding for fintechs that depend on BaaS is likely to shrink, with investors demanding much closer checks on risks, legal compliance, and backup plans. We may see people move towards safer choices, sticking with traditional banks or fintechs that have their own bank licenses or simpler, clearer partnerships. The first shock from the collapse of Yotta Bank, caused by the big failure of its banking partner, Synapse Financial Technologies, has now settled into a long and difficult situation. It has been over a year since Synapse filed for bankruptcy on April 22, 2024, and the hope that customers would get quick help has faded. Instead, people now face long legal fights, stronger government attention that many think came too late, and a troubling question about whether the fintech dream was ever strong to begin with. What once looked like a big flashing warning sign has turned into a steady, burning problem that continues to harm the savings and trust of everyday people. At first, people were told that hard work was being done to fix accounts and return money, but now that story has fallen apart. While banks like Evolve Bank and Trust have said they returned most of the frozen $219 million, this means little to the people who still have missing money in their accounts. In April 2025, the bankruptcy trustee, Jelena McWilliams, who used to be head of the FDIC, shared more bad news. The work to fix the Synapse accounts was coming to an end. The reasons included the very high cost, the confusing and poorly kept records at Synapse, and the small amount of money left to pay for the work. There is still a gap of about $65 million to $95 million in customer funds, which shows how bad the situation really is. For many, this missing money was meant for a home, savings, or an emergency. Even worse, no company has agreed to pay to keep Synapse's records safe for the future, which could make it almost impossible to track down the missing money later. What happens when the digital trail disappears? Not because the data is gone, but because no one wants to pay to keep it stored. Without a full effort to fix the problems, customers are left in an even worse situation. Who will now stand up for them to help solve the remaining issues? Maybe the courts, but that path is long, costly, and filled with challenges. Yotta customer Dustin Justice and others filed a lawsuit against Evolve Bank and Trust and Lineage Bank, saying they acted with great carelessness and poor management. This lawsuit gives some people hope, but lawsuits can take years and do not always bring results. The claims in these cases are very serious, accusing these large banks of failing at their basic duties, like watching over funds, keeping clear records, and having strong backup plans. Yotta has also filed its own lawsuit against Evolve, accusing the bank of wrongly using funds and mishandling the movement of important accounts, involving tens of millions of dollars. This shows how all the groups involved are now blaming each other. The most serious accusations have come from the political world. In April 2025, on the anniversary of the bankruptcy, Senator Elizabeth Warren wrote a sharp letter to the Federal Reserve. This was not just for show, it was a public attack on Evolve Bank and Trust, claiming that the bank knew about missing funds as early as 2023, but did not tell customers. The letter also said that Evolve took $26 million in fees from Synapse customer accounts between 2019 and 2023. On top of that, there is now a federal grand jury investigation, which means the problem has gone beyond poor management to possible crimes. This is no longer just about bad paperwork. It's about whether banks and their leaders knowingly put people's money at risk, and whether they acted as if they would never get caught. The response from government regulators, while it finally arrived, feels like an ambulance showing up long after the crash. When the Federal Reserve took action against Evolve Bank in June 2024, and when the FDIC made a consent order with Lineage Bank in January 2025, these steps were needed but came too late to help those already hurt. In July 2024, the Federal Reserve, FDIC, and OCC released a statement admitting that bank fintech partnerships carry risks. The FDIC even proposed new rules to make sure banks keep better track of accounts. These are good steps forward, but for the people hurt by Synapse's collapse, these efforts feel like too little, too late. The real question many people are asking is why companies like Synapse, which worked with over 100 fintech companies and thousands of customers, were not better watched before things fell apart. Regulators already had the power under the Bank Service Company Act to examine companies like Synapse, but it seems they did not use that power strongly or wisely, especially as the fast-growing fintech world became more confusing and hard to control. As Solid's fall mirrored Synapse's devastating collapse, the question burned hotter than ever. Would fintech's dazzling innovations forever mask a predatory core, leaving everyday people to pay the ultimate price? When fintech dreams become regulatory nightmares for savers. To make matters worse, the collapse of another BaaS, banking-as-a-service provider, Solid, in April 2025, sends an alarming message. Synapse was not just a random disaster, it was a sign of deeper problems in the system. This raises serious questions. How many other fintech companies are depending on BaaS providers that are just as unclear or shaky in their operations? Are regulators now rushing to catch up and check a sector they allowed to grow without enough careful supervision? The big fear is that even though regulators are now working hard, it might feel like they are trying to patch up a dam that is already broken wide open, while the people who caused the problems may still escape without serious punishment. The human cost of this crisis keeps growing and reaches far beyond the first panic when accounts were frozen. For many people, this is not just a small money problem that will get better over time. It has completely thrown off their life plans. Families that saw their house down payments disappear are no closer to owning a home. Students who lost money meant for tuition now face breaks in their education and rising debt. Small business owners who depended on these fintech services to manage their money have struggled to pay workers and suppliers, and some businesses may never recover. All this has caused emotional harm that cannot be measured in dollars. People once trusted these easy-to-use apps that promised to make banking better, but that trust has been shattered. Even the FDIC insured label, which once gave people comfort and a sense of safety, now feels like a cruel joke, reminding them of the fine print and loopholes that made that promise empty. Looking ahead, the future of fintech and BaaS is full of uncertainty. Many BaaS providers now use the phrase compliance by design, meaning they claim to build their systems with strong rules and safety from the start. But will this really lead to stronger, safer systems, or is it just another round of flashy marketing to bring back nervous investors and upset customers? Venture capital, which used to pour into the fintech world, will now likely demand much more solid proof that these companies can manage risks well, handle money properly, and work in clear and open partnerships with banks. This shift could, in some ways, help the fintech sector become healthier and more stable, moving it away from overhyped promises toward real financial strength. However, the change will not be easy, and we will probably see more companies fail as those that cannot meet the new demands or secure funding are pushed out. Other fintech companies that still depend on the traditional BaaS model are probably doing a serious review of their own risks right now. Switching to a new BaaS provider is expensive and complicated, and trying to get their own banking licenses is an enormous task that requires a lot of time, money, and effort. In some ways, these fintech companies are also victims of Synapse's failure. Their names have been dragged through the mud simply because they were connected to Synapse, and now their customers have every reason to be cautious. The Yotta and Synapse situation has exposed a dangerous belief that innovation in finance can run ahead of regulation without causing serious harm. It has shown the dangers of handing over important banking tasks to middlemen who are barely watched or regulated. The smooth and easy look of many fintech apps hid a messy and fragile system underneath. As the lawsuits continue and regulators slowly adjust their rules, one of the hardest and most heartbreaking questions remains for the people whose money is still missing. Will they ever get their money back? Or will the Synapse failure go down in history as just another sad story where, in the end, everyday people paid the biggest price for the failures of a system that was not properly watched? The damage left behind by this collapse is wide and deep, and the road to winning back both the lost money and the lost trust looks very long. For many families, students, and small businesses, this crisis was not just about money. It was about lost hopes, broken dreams, and the painful lesson that even in a world filled with new technology, old problems like poor oversight, bad management, and greed can still cause great harm. As the world of fintech moves forward, the biggest challenge will be making sure that the promise of innovation is matched with real responsibility and fairness. Only then can people begin to believe again in the idea of a better, safer way to manage their money. If regulators fail to protect everyday savers in the Yotta Synapse collapse, should we trust fintech again or demand stricter government control? Let us know in the comments. Smash like and subscribe for more.